Sunil Koul is with us now. Let's put some questions to him about the markets. APAC equity strategist with Goldman Sachs. Sunil, great to have you with us here. Thank you very much for your time. So just wanted to get a first sense from about you about what foreigners are doing, because I mean you'd have interactions with large global funds, emerging market funds, etc. At the margin, one has been, and it's now found its way into mainstream press. There was an article yesterday saying that many emerging market investors are starting to unwind the long India, sell China trade, tactical, etc. But I mean, it quoted some very large fund managers with large AUMs. Is that something you're noticing? I must say, the reason, of course, which was cited by most of them was valuations, the big valuation differential, and also kind of pointed out that it's largely tactical. But is that happening, Sunil?
Yeah, I mean, first of all, Prashant, pleasure to be back. Look, I mean, some of it is happening. As you said, the primary concern around India in terms of clients has been around valuations. Although I would say our core view is still positive on India. We still think that the fact that fundamentals are strong, earnings are coming through, that should offset some of the concerns around valuation. So we still like the market. On your question about India versus China, I mean, the market, if you look at the Chinese equity market, the market actually has rallied around 15% or so from the bottom, right? So the China rally is already kind of taking place. And on the margin, we actually have seen some investors kind of getting into that. But as you said, I think a lot of the investors we speak to who have sort of got into the China trade are largely either hedge funds or quant managers, not a lot of the long onlys in there. So I would say that also explains that on the margin, people are kind of viewing it as a tactical trade, and there are some people doing it. But our sense is that if you look at the broader pool of money, including some of the global funds, which are much more bigger than the Asian and the emerging market money, they're still sort of underweight India. And because of the stronger fundamental story, you can still see allocations improving in India over the next course of next 12 months.
Okay, allocations could improve in India over the course of the next 12 months. By the way, it's not a bad market at all. Just look at that. The Nifty is barely down about 0.3%. The mid-cap index actually is down just 0.2%. So given the kind of global volatility, this is a very, very resilient market that we have on our hand. Sunil, hi, good morning. I want to talk a little more about the broader, perspective on the market. But before that, we were just mentioning how CLSA has sort of upgraded the IT space now. And I noticed in your own report that you have also raised your stance on the IT sector to neutral. I want to understand, is that because valuations are looking attractive now? Or do you think the worst of, cut down in client spends, lower demand, etc., is out of the way? What's your rationale there?
Yeah, Sonia, I think that's a great question. I think it's the latter. So we do think that numbers bottomed out in the December quarter. So I think the March quarter numbers and the 1Q reporting season, which will just start, I think the numbers may still be a tad softer, obviously given the guidance from Accenture as well. But we think March will be better than December already. And going into the second half of the year, we think numbers will start to improve much more materially. Bear in mind, as I have spoken before, we also have a much more constructive on the US economy as a whole. So we don't obviously have a recession as our forecast, and seems like market is coming to that view as well. So overall, our sense is that, I mean, IT is a sector which has obviously underperformed quite a bit if you look at the last 2 years in general, and the numbers have been cut a lot. And so our sense is that things have sort of bottomed out here, so you could see better performance from the sector as a kind of a catch-up laggard as well.
All right. Hi, Sunil. Good morning and good to see you. When central banks are going to be in focus for this year, what are you all penciling in terms of Fed action? Since you're saying that the US economy could be stronger than anticipated, so what kind of rate cuts are you all penciling in from the Fed? And what about the RBI? How many rate cuts do we get out here?
Yeah, look, Nigel, I think we still are in the June cut camp. I think that the Fed rate cut cycle starts in June. I think having said that, so we're kind of penciling in 3 rate cuts this year. Having said that, I think that's one risk we are sort of closely monitoring, because kind of we came into the year thinking that you'll have 6 to 7 cuts. Now that's already sort of down to 3 cuts. I think market is kind of also pricing in 3, although there is a active debate whether that sort of gets to sort of 2 cuts, depending on how the US data pans out. So I think that's one thing we're kind of closely monitoring. But as a base case, I would say we do think sort of Fed goes in June. We do think that we have around 3 rate cuts this year, another sort of the 3 rate cuts next year over the course of the next 12 months. So we see kind of central bank cutting across the board in most parts of Asia as well. barring obviously Japan and some markets like Malaysia, but pretty much everywhere else across the board. So that should be positive for equity markets. For RBI in particular, I would say, I think the key, obviously we expect them to stay on hold in the policy meeting later this week. Obviously, they'll be probably sounding more optimistic on growth, commit the 4% inflation target eventually. But I think what's more from an RBI standpoint is what happens on the liquidity front. And barring the near-term policy meeting, our overall stance is that obviously liquidity was very tight in the system for the last 2 quarters or so. Things have already started to ease in the last month or so. So if you obviously look at both the interbank rate, but also the CD rates, they already started to ease off, right? So liquidity in the system is improving. Our own sense is that this quarter you will see liquidity easing much more, and eventually RBI starts cutting rates in third quarter of this calendar. But the rate cutting cycle, we think in RBI's case, will be much more shallow. We are kind of baking in only 50 basis point of rate cuts. So it goes from 6.5 to 6%. So not a huge cutting cycle, but I think what's more important, what the markets will like, is the fact that liquidity is already easing, and we think more of that will happen in this quarter as well.
Sunil, I know the broad view is that you think rotation into large caps will continue, right? As you get closer to elections, is what you write in your report. You also highlight 10 or 12 names in the mid and small cap space where you think there is a fair bit of crowding in which has happened. But let me ask you on the other side. I mean, it's a large and now deep investable market in that sense. Deeper, it's all relative, of course. So highlight some names for us where you're still finding opportunities in that space, in the down the curve, market cap curve, which you've put out, where you've coverage and which you like. Yeah.
Yeah, look, I'll answer it two ways, Prashant, without getting into single names. I think one is that if you look at the broader market, I would say the theme of alpha still continues to play out in India, right? I think the first quarter we just went by is a good reminder of that, right? If you just looked at the mid and small caps obviously have corrected only 5 to 10%. If you look at Nifty, it's only up 3% or so. Probably MSCI India is up 7%. But if you look beneath the surface, right? I mean, there is a huge sort of a wide sort of dispersion between sectors, between stocks. I mean, just to give one or two examples, if you look at the consumer pack, right, you have discretionary outperforming staples by more than 20 percentage points in the last 3 months, right? If you look at, for example, commodity space, you have energy outstripping metals and mining and materials by 20 percentage points. So if you look at beneath the stocks, even in MSCI India, which is not just large cap, it's basically large cap plus mid cap, you have 40% of stocks which have given double-digit returns. You have 30% of stocks that are down for the year. So there's a huge sort of dispersion within the market, which is already underway, on top of the entire rotations which you just mentioned, right? So we think the environment continues to be like that. Now, in the sort of value pockets, the way you asked the question, I would say there are still sort of themes we like within the market, and the way we kind of pick up the stocks is kind of where fundamentals are strong. These are buy-rated companies which our analysts like, and then they also kind of belong to one of the themes we have. So, for example, some of the themes we have been mentioning in our reports is this. You mentioned the rotation into large caps and the quality large cap names, but sort of beyond those large caps, there's also the theme of kind of high-end consumption, affluent India, as we call it. There is a theme of make in India. There is a defense theme going on. We also are very bullish on the real estate cycle, and we think the best way to play that is through the building material or the late cycle construction materials. So if you go through these themes, I think there are enough themes within the market which investors can play. And then when you sort of look at the stocks, we sort of go with the analyst picks where we have the most conviction on.
Okay. I wanted your thoughts. I mean, I do notice that in some of the names that you own, right, some of the names that you've mentioned, whether it's RVNL, whether it's IRCON, something like a JBM Auto, these are in spaces that have grown very fast over the last couple of years, whether it's railways or EVs, etc. But you mentioned that now it's become a bit of a crowded trade, as well as valuations are expensive. So what do you do in these pockets? Do you sort of churn out? Do you continue to keep the faith here? What's your stance?
Yeah, look, I think within the mid cap, I would say, I mean, obviously the headline index is only 5 to 10% down, right? But that's, I think, masking the broader sort of deeper correction that has happened within these indices, right? So one of the things we also highlighted in the report is that if you looked at the sort of mid cap 150 stocks and the small cap 250, which is basically the 400 stocks beyond the top 100 names. So within those 400 stocks, more than half of them, so more than 200 stocks, have actually corrected double digit already, right? And there are some stocks that have corrected 35 to 40%, right? So there is some deeper correction that has happened in the pocket. And so obviously some of these stocks, as I mentioned, that still belong to some of the themes we like selectively. We do like those stocks. The stocks which we think are under risk, as you pointed out, are the ones where we think despite the recent correction, stocks are still more than 100% up in the last 1 year. So the price move has been very extreme. B, your valuations are running more than 2 standard deviations, so it's kind of harder to justify that things are, even the numbers are not in the price. And C, when you look at the top sort of domestic mutual funds, all of them are kind of owning the same stocks. These stocks also look pretty crowded. So that's one sort of pocket of the market, somewhat smaller, where we think it's worth kind of monitoring that risk, and probably there could be more downside there. But to your earlier question, if there are stocks that have already corrected, as I said, 30-40%, and we like them thematically, that's an area to build up exposure.
Okay, all right, Sunil, final question before we let you go. You know, the Chinese markets have bounced, but as you said at the start of this conversation, it's missing out on long-only funds, so that's important to note. But how do you play this entire commodity pullback that we're seeing? You know, metals move with momentum. Valuations, it's already, gone through the roof in comparison to, say, a 5-10-year average. But how are you all placed on Indian stocks, the metal-facing stocks?
Yeah, so we don't have sort of active coverage, unfortunately, Nigel, on the metal space, and so we kind of market weight that space. But I would say within the broader commodities sort of cohort, the way we are kind of placed within our allocation is that we like energy, so sort of refiners, obviously, and the index heavyweights there, which is not just energy view, but also kind of the telco plays and the inflection in capex and the free cash flows there. So we like some of the refiners and the index heavyweights in the energy space. We as I said, metals, we're kind of more neutral there. We do like, if you club utilities in the broader commodity spectrum, we do have an overweight on utilities, which is more a thesis around sort of peak power shortages happening and focus on renewables. So that's another way to play that. Where we are most cautious on within this sort of cohort is the oil marketing companies, where we think there is still pressure both on refining margins, but also on the marketing margins. And obviously these are kind of contra oil plays typically. We still think oil kind of is bouncing around at $80 on Brent. And there is sort of downside on the margins, and these stocks have rallied a lot, so we're kind of much more cautious there. So I would say, like utilities, like refiners, more neutral on metals, and cautious on OMCs.
Okay, well, thanks a lot for joining in, Sunil. Appreciate your time here. That's the word coming in on the markets and on individual stocks and sectors, what you can do ahead of the, the pre-elections rally, as well as the markets overall.